Hi, I'm David Scranton, and today we're going to be talking about investing for income, but in a different way from last week. Specifically, we're talking about dividend investing in the stock market, but only for those of you who have the right risk tolerance level. You guessed it, it's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. As it turns out, there's actually a simple way to explain investing for income. It's a strategy designed, yes, to generate income through interest and dividends, but to do it while helping reduce your volatility. Yes, the concept is simple, but not easy. Why? Because it can be extremely difficult to execute. And that's especially true when we're talking about a strategy that includes dividends in the stock market. You know, there are a lot of misconceptions about dividend investing, especially today when everyone thinks that all you need to have really to be a Wall Street whiz is the latest investment app. Today, we're going to clear up those misconceptions. Specifically, we'll be talking about what dividends are and how they work, how a high dividend value-based stock strategy can be a powerful tool in your income-based portfolio if, and that's a big if, you have the right risk tolerance level. Also, the difference between value stocks and growth stocks, and finally, why investing for dividends can be a lot harder than investing for growth in the stock market, in spite of what many believe. In last week, we spoke specifically about investing for income in a contractual basis. But now today, because we're talking about doing it with investments, i.e. stocks that don't have a contract, it requires the right risk tolerance level. So first, let's answer the all-important question. What are dividends anyhow? Well, as you might know, dividends are payments that are made to shareholders by companies, and generally they're based upon the amount of the company's profits. When you own dividend-paying stocks, you receive a share of the company's profits in that form of regular dividend payments paid quarterly. In other words, you get your return or part of your return in the form of income. And this, of course, is what makes it an income-based strategy. However, be aware that even when investing for dividends rather than capital gains, stocks are almost always considered to be riskier than bonds. And one reason is that a company can cut or reduce dividends at any time. And some did this last year because of the coronavirus recession. All the same, the right dividend strategy can still help you lower your stock market risk and give you a more practical way to invest in stocks as you approach retirement. So what is the right strategy? Well, in my experience, if you're going to be in the stock market, it should be through a high dividend common stock strategy, which typically means a value-based strategy instead of a growth-based strategy. So, okay, Dave, I can hear you saying, what makes it the right strategy? Well, for one thing, a value-based strategy involves buying stocks that you deem to be undervalued. Typically, those should have somewhat less downside risk than the overvalued growth stocks that many of you might have in your mutual funds or exchange-traded funds. And in addition, the dividend-paying value strategy is, like virtually all income strategies, a bird-in-the-hand approach to investing. So here's an analogy that I like to use to explain what it means. Let's say that two different couples decide to invest in real estate. The first invests in a plot of land, hoping that its value appreciates by the time they retire so they can sell it for a profit. Then, just as they're about to retire, the real estate market bottoms out, and the value of the land goes down instead of up. Now, let's say the second couple invests in a rental property as an alternative. Each month, this couple is able to collect rent from their tenant. Due to that steady income stream, they're much less worried about a potential drop in property values. They know the income they're getting will help soften the blow if that happens. Also, if they don't need to sell the property at a particular time, they can keep it until the real estate market recovers. In the meantime, they know they can count on their rental income either way. Most income-based investment strategies tend to work kind of sort of in the same way, including a dividend-paying value-oriented stock strategy. Now it's time to bring in my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So Jeff, are you as excited as I am that I believe today will be the 10th time that we have the pleasure of interviewing our good friend Steve Forbes?
Yeah, Dave, and not only do we get to interview that icon, Steve Forbes, but we also get to chit-chat with him in between the sets, which I love doing. I love talking to Steve.
Yeah, it's always fun when you talk to him talk to him on a personal level. So, getting to the subject at hand here. Obviously, this dividend-paying value strategy is one of what we call this bird-in-the-hand approach. Why is that true?
Well, if you're retired, it's always better to have a bird-in-the-hand approach because you're going to be focused on creating dividend income from that portion of your stock portfolio, which is going to give you staying power in two ways. One, to buoy your money if the market drops, and two, to create income in retirement. So that's really important, Dave. It also protects as a hedge against inflation as well. But on a different note, Dave, I know how I do it, but I want to hear how you do it. How does dollar cost averaging improve the growth of a portfolio?
Well, not for those who are taking the dividends, as you mentioned a moment ago, but for those who don't need the dividend right away and are reinvesting it, then essentially when the market drops, they're able to buy more shares in a down market, essentially getting their average purchase price of that stock down. So now when the stock eventually recovers, their break-even point comes a lot quicker. But when you talk about making money in stocks or any investment, you have to talk about the after-tax return that people earn. So do you mind sharing with our viewers, our listeners, a little bit about some of the tax benefits they might find when investing in dividend-paying common stock strategies?
Sure. The good news about that is there are tax benefits, Dave. They're taxed at a much lower rate. Dividends are taxed at a lower rate than ordinary income tax rates. So it's very advantageous to have dividend income from a taxable perspective versus ordinary income. Now, a similar question could be, Dave, what are the most common follow-up questions you get from clients when they talk about the bird-in-the-hand approach or the bird-in-the-hand concept of dividend investing?
Well, let's go ahead and let's ask one right now. It's a great segue, Jeff. I appreciate that. Let's go to our Ask Dave segment. So a viewer writes in and says, you mentioned that companies can cut or reduce their dividends at any time. And generally speaking, how big of a risk is that when investing for dividends? Well, the way I like to answer this is it's certainly a big risk if you're not careful. We're going to talk later in the show about value versus value trap. But if you can avoid the value traps, then typically speaking in a down market, the price of stocks drops by a much greater degree than the dividends decrease. And frankly, companies are really hesitant to cut dividends unless they really, really have to. But be sure to submit your own questions to Ask Dave. How? By emailing me at askdave@theretirementincomeStore.com. And coming up right after the break, we're going to be able to have that interview we've been talking about so far with our good friend Steve Forbes, right back here on the Income Generation. We'll be back in a moment. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749, online at theretirementinComeStore.com.
Welcome back to the Income Generation. I'm David Scranton, and it's great to be here with all y'all to talk more about dividend-oriented value stock strategies and their relationship to growth stocks. But in order to really understand value stocks, you need to know about their counterpart, growth stocks, which are also known as momentum stocks. So when a company has higher growth potential, it can increase its market share in different ways. So it probably doesn't want to pay dividends because it makes more sense to reinvest profits back into the company internally. Stocks for these companies tend to have higher price to earnings or PE ratios. In fact, they often are deemed to be too high, making them what people refer to as overvalued. On the flip side, value companies tend to be mature, well-established businesses that are still highly profitable, but with fewer internal opportunities for growth. And as a result, they typically prefer to pay a higher percentage of their profits out to you in the form of a dividend. So as you might have guessed, they also tend to have lower PE ratios, making them potentially undervalued, thus the term value stocks. However, remember that we're talking about business and economics here, so nothing is ever simple. And as everyone knows, no company can remain mature and highly profitable forever. Eventually, competitors come along and cut into those profits. Think about it. Companies like Woolworths and Montgomery Ward were once the kings of the market. Then companies like Sears and Kmart came along and dethroned them. Those companies were eventually replaced by chains like Target, Marshalls, and Walmart, which are now running the risk of being replaced by Amazon. So here's the point. When a true value investor is trying to decide which stock represents a good value, that person typically has to ride what I like to call the knife's edge between two different things. Dividend-paying companies that are at the beginning of the mature stage versus those that are on the tail end and possibly on their way out. And this can be one of the biggest challenges for a dividend-based analyst. One reason is that companies declare dividends in dollars paid per quarter, not in percentages. Therefore, a stock will sometimes look cheap and boast a high dividend percentage, but it's only because the price of its share has dropped recently. In reality, it could be at the tail end of its mature stage. That means it may eventually have to cut dividends as the price per share continues to drop. Analysts refer to this as a value trap. So Jeff, in your professional opinion, do you think that most investors really understand the difference between value stocks and growth stocks?
You know, Dave, they really don't. They lump value and growth stocks as growth because when we think of the stock market, the average investor feels appreciation only, Dave. And so that's a problem because they don't know the difference. But in terms of recognizing, let's say, Dave, a good value stock from a value trap, what are some of the other things a professional investor might look for?
That's a great question. And I guess the simple way to put it is with value investing, the investor, their research begins where it typically ends. And so in other words, you're looking at, yes, all the financials like you would normally when buying a growth stock. But then in addition to that, you've really got to read a lot about different people on Wall Street and their opinions as to whether this is really temporarily undervalued or perhaps permanently undervalued and essentially a value trap. And really only by reading the opinions of other professionals smarter than you can you really get, at the end of the day, can you really get this answer and decide whether you think it's a value or a value trap as an investor. But tell me, in general, you know, when a client of yours comes in and says, I want to put more money in the stock market, in general, what do you tell them?
So Dave, when clients tell me they want to put more money in the stock market with where market is today, I always emphasize that we have to focus on getting a maximum dividend approach because that's really where we're going to get most of our growth the last 10 years. It's where we've gotten most of the growth the last 20 years. However, Dave, it can be very challenging for the average investor to go out there and do that by themselves. So tell us about how we solve that problem for our clients.
Well, Jeff, it's more challenging primarily because you're trying to ascertain this difference between value and value trap that we're to be talking about much more later on in the show. And also a great friend of the income generation, Steve Forbes, Chairman, CEO, Editor-in-Chief at Forbes Media. Steve has written several best-selling books, and he's also campaigned for the presidency twice. Steve, thanks so much for being back with us on the Income Generation.
Good to be with you both. Thank you.
So give us your general views on dividend-based investing in the stock market for your average income generation member.
Well, in this time of zero interest rates where you need a microscope sometimes to find it and where you have to go way on the risky side on bonds to get a real yield, dividends seem made to order. And the nice thing is you can pick stocks that have dividends that increase each year or have a history of increasing. And And we all know when times are tough, yeah, dividends may be cut, but the cuts are not nearly as bad as the cut in equity value. And dividend stocks keep coming back. They're ideal for retirement accounts. So the nice thing about dividends, David, is you get cash, not the promise of a gain. You have real cash in hand. That's nice.
Love that explanation, Steve. Jeff Small here. Hey, what's the biggest thing, though, that typical investors don't understand about dividend investing?
Well, I think that dividends sometimes can seem slow compared, especially when you have the kind of volatility we've had in the market recently. We've seen the huge increase in high-tech stocks. But the thing about dividends is it's not a bond, it's not a preferred stock. It is something where the equity value can increase as well. You take Apple, that doesn't have much of a yield, under 1%. But if you'd bought it 5 or 6 or 10 years ago, it's a juicy yield because the company grew. And so you got, even though the dividend seems small in terms of yield, it is actually on your original investment very, very good indeed. Far better than anything you would have found from junk bonds and the like. So again, pick a good stock that has real growth opportunities, and dividends do come along. Someday I predict even Amazon will pay a dividend. But look at Microsoft. For years, they didn't pay a dividend. Now they've had both equity, a nice boost, and also the dividend compared to the price you would have paid 10 or so years ago. Looks very nice, too.
So, Steve, you wrote an article recently about why Congress should not propose or enact a ban on short selling. Why would that be a mistake?
Because short selling is a way of bringing reality back to the marketplace, or at least temper animal spirits that can sometimes dominate the marketplace. We all know emotions run wild in the marketplace. Mm-hmm. And so if you think that equities or some other instrument is going up too far in value, it's really no different than selling the stock, but only in this case, you borrow the stock, taking the huge risk. But you borrow the stock and then sell it, but you have to pay that stock back. And if the stock goes up, you're going to take a huge loss. And as you well know, with short selling, the losses can be infinite. Whereas typical investing, buying long, you can only lose what you put in. But short selling does have a place in the market. And the idea that they can dominate the marketplace, well, we've seen recently that ain't true. No matter how big you are, there are a lot of other investors out there who are going to play off of you.
Sounds like to some degree what you're saying is if you try to remove the animal spirits from the stock market, in some ways it's not really even the stock market anymore, right?
Well, that's it. And emotions are your enemy. And it's amazing how, David, each generation, we have to have a new slew of investors learn that what goes up rapidly can go down rapidly. And stocks really are just discounted cash flow of future income streams, as you well know. And that's why you try to look for companies that have durability, because those are the ones who can give you cash returns in the future and growing cash returns. That's, again, right, about picking good dividend stocks is your income grows.
Right, an inflation hedge, absolutely. We need to take a quick commercial break. When we come back, we'll have much more in terms of words of wisdom from our good friend, Steve Forbes. Stay with us right here on The Income Generation. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to The Income Generation. It's great to be here with you all. I'm Dave Scranton. I'm here with Jeff Small and a good friend of The Income Generation, Steve Forbes, Chairman, CEO, Editor-in-Chief at Forbes Media, and also someone who has campaigned for the presidency twice. And Steve, we get some time before we end. We'll ask you one political question, but getting back to our conversation about dividends, is there a better time or a worse time to invest for dividends in the stock market if you're part of the income generation?
I think in terms of dividend investing, if you it's always a good time, but you just have to be careful of it. Just don't look at yield, because if a company is maturing and not competing, that dividend will be in jeopardy. So you got to look behind the curtain, so to speak, to make sure you've got a company that has good cash flow that can increase the dividend each year. And sometimes you're going to pick a clunker, but if you have a decent spread of a portfolio, again, those dividends will rise and you'll feel very good about it. But the thing is, even when you have a terrible bear market, such as we had in 2008, 2009, the whack in dividends was nothing like what happened to the value of stocks. And the dividend stocks came back, and so did the dividends. And that's why you want a vibrant economy, because that means profit. And the nice thing about dividends means the company is sharing those profits with you in a very tangible way.
So speaking of a vibrant economy, Steve, in the past shows we've talked about taxes and politics, but last night I paid $2.85 at the pump. Energy prices are up 70 cents, $1.25 at the pump itself. And so at what point does that start to hurt a vibrant economy?
Well, it's hurting. It's going to take a bite right now. We do have an economy that I think is ready to roar, in the sense that people, after a year of shutdowns, lockdowns, told to be careful and all that sort of thing to cope with this terrible pandemic, people, I think, are ready to have some fun again, get out, intermingle, travel. So I think the economy will do well. But one of the big dangers out there is inflation. The Federal Reserve is going to be printing a lot of money. Washington is spending money like never before in peacetime have we seen this scale of spending. And they don't think there are any consequences to all this money printing, but there will be. And with the dividend stocks, by the way, everything will be hurt by inflation, but a good company will be able to make profits. In real terms, it may not be what it was before, but you're going to still get that income stream that'll be better protection against inflation than even inflation bonds, those bonds that the government sells, hedging for inflation. The way the formula works, I think you do better with a good portfolio of dividend-paying stocks that have a history of rising.
Yeah, I agree completely, Steve, with that comment about the inflation bonds. So I can't help myself. I have to talk to you about politics just a little bit, because one of the big benefits of investing for stocks, in dividend stocks with a higher income taxpayer, is that the dividends have preferential treatment. Do you think under the Biden administration there's a chance that that can go away or get significantly reduced, that dividend tax benefit?
Well, that's the thing. Everything is at jeopardy with this administration, including a slew of new taxes like wealth taxes, carbon taxes, which will raise the cost of energy even more than what we've been experiencing so far. Yeah, that's a danger. And that's why I think we have to be active politically. We've got a 50-50 Senate, and we've got to make sure the GOP holds out, preserves the filibuster, so the Democrats can't steamroll these bad things, and make sure that certain Democrats, like Tester of Montana, Senator Sinema of Arizona, and Senator Manchin of West Virginia, hold the line on some of these excesses. So sadly, nothing is permanent, but you got to make sure that they don't take that away, and because they're going to do a lot of other damage to the economy, and that's why we got to make sure they don't take away these things that make investing remain worthwhile.
Steve, what are your final thoughts that you'd like to have our income generation members know about your philosophy about investing for people in that age group?
Well, in terms of investing, you got to realize emotions are your enemy. So with your retirement accounts, depending on whether you're drawing them down or not, I think you just take the cautious approach. Don't try to be a market timer. Continue to do sound things, and over time you'll do fine. Even with this administration messing things up, eventually they'll be replaced if they mess things up. This country eventually gets back on track. And in the meantime, with your portfolio, keep a cash reserve. Yes, we know the cash doesn't earn anything these days. Maybe have a little bit of gold as a hedge, not as an investment, but as a hedge. Sure. And then have sound equities, and you'll ride the storm through. The problem is everyone that says, oh, yeah, I'm a disciplined investor, then the market goes down. You say, oh, is it too late to get out? Maybe I should take more off the table. Emotions reign. So just remember, emotions are your enemy, and have a portfolio that you can be comfortable with at night, including that cash reserve.
Yep. And if you do happen to find one of those clunkers you referred to a moment ago in your portfolio, don't beat yourself up too badly, because even the professionals pick clunkers every once in a while. Steve, thanks so much for being here with us on the Income Generation. It's been great having you. Our pleasure once again.
Thank you. Thank you, David, and thank you, Jeff.
Let's talk more about investing for dividends in the stock market. As I said before, some things are easy and some things just look that way, at least until you've tried them yourself. And I know from experience that a lot of do-it-yourself type investors believe that investing for dividend income in the stock market is actually easier than investing for growth. They think it's a simple matter of buying any well-known dividend-paying blue chip stocks and collecting the dividend. Bada bing, bada boom, right? It's all over. However, if you take anything away from today's show, I hope it's the fact that it's not simple at all. Actually, what most people believe is the exact opposite of what's true. See, investing for income in the equity markets is actually much more difficult than buying a stock on the upswing and trying to capitalize on momentum. The truth is, that strategy can actually be pretty easy for someone with a basic understanding of markets and their ability, therefore, to buy a stock on momentum. Why? Because when stocks start to gain momentum to the upside and they break through a certain glass ceiling known as a resistance level, it allows investors to jump in and to ride that momentum upward. For instance, you can always follow a high-flying stock like an Amazon or an Apple. If it goes up for a few days in a row, you can buy it. You can continue to ride it up and not sell it until it reverses its trend. Plus, if you have the means, you can use an automated stop-loss order. This is basically a standing order to sell the stock if it drops below a certain price. That way, if the stock loses momentum and experiences a couple bad days in a row, it's sold automatically and allows you, essentially, to take your winnings off the table. Naturally, none of that is really as easy in real life as it sounds on paper. And unfortunately, most everyday investors don't have the means or the money to play markets in the way I just described. Conceptually, though, it certainly isn't rocket science. The fundamental laws of growth and momentum actually make it relatively easier to invest in the stock market using momentum than using the in-depth analysis that's required to successfully invest for dividends. And that's why most investors, I believe, take the easy road out, and they keep their clients invested in growth-based strategies, oftentimes lazily leaning on common stocks or common stock mutual funds, even after those clients have reached the age where income should be their top priority. Jeff, I got to imagine all your years of experience that you've run into this common misconception yourself many times over the years.
Yeah, I really have, Dave. People think it's really easy just to go out and buy some stocks, maybe blue chip stocks that are going to give you that value and that dividend, but it's not that easy, Dave. It's really tricky. And tell us, why is it tricky?
Well, we talked about just in the last segment, one of the biggest reasons of trying to determine this whole value versus value trap thing. These are mature companies we're talking about. Are they at the beginning of the mature stage where they're going to have more growth ahead of them before they decline? Or are they at the end of the mature stage about to go in decline? And that is not easy in any way, shape, or form. But it's even harder than that, isn't it? In some ways?
It really is. I mean, one of the things that a professional advisor will have access to is a fund analyst who will call shareholder services to inquire on value stocks that they might be interested in. And the reality is, average investors aren't going to be able to do that, Dave. It's too complicated, and shareholder services is probably not going to talk to them.
Yeah, that's right. I mean, if you're a small investor, they may not want to talk to you. But again, I can't stress enough that this really, you have to have the right risk tolerance level in order to be able to do this. Because if you make the wrong call and it turns out to be a value trap instead of a truly undervalued stock, then you can lose money. And ultimately, not only do you lose principal, but if the dividend gets cut, then you lose income also. And coming up right after a break, we're going to talk about how dividend investing in the stock market can be your friend, whether the market goes up or even if the market goes down. Stay with us. We'll be back with more coming up on the Income Generation. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
If you're 55 or older, please claim our free Retirement Income Kit, chock full of information you need to know to get steady income during your retirement. Call 866-314-7227, online at theretirementIncomestore.com.
Welcome back to the Income Generation. I'm David Scranton, and it's great to be here with all of you. Let's now take a moment and talk about your risk tolerance and how that applies to investing for dividends. Some of the reasons why I keep stressing that you need to have the right risk tolerance in order to make value-based, dividend-oriented investing part of your income plan are possible dividend cuts, trying to avoid value traps, as well as the fact that these types of instruments lack having a contract, just to name a few. And as we've shown, it's definitely not a simple matter of just picking the winners and sticking with them. In fact, not by a long shot. Like any kind of stock market investing, there's a much greater element of chance involved. Why? Because as I said, number one, it's not contract based. Also, things tend to change quickly, much more so in the stock market than they do in the universe of bonds and bond-like instruments. And although, as we've also seen, a dividend-paying value strategy can still be part of a sound retirement plan geared toward reliable income and risk reduction. More specifically, a well-managed portfolio of dividend-yielding value stocks can be a key part of your income-based strategy. In addition, it can be a better option within 10 years of retirement than the common stocks and stock mutual funds that you might currently own. One reason is the reliable income that we've been discussing, but another is the upside growth potential that it can give you. As I explained a couple shows ago, this isn't growth potential that's based on crossing your fingers and toes and hoping for growth through capital gains. Part of it is, but there's another part of it that's based on the strategic approach of reinvesting dividends to buy more shares. And this can actually work in your favor even more so when the stock market falls by helping you with this concept called dollar cost averaging. So let's say that you start the right dividend-paying value strategy 5 years before retirement. And let's say you're getting maybe 4% dividend yield over that time. That's money that you don't need yet because you're still working. So you can use it to keep growing your savings. Perhaps the market keeps growing during those 5 years. That's great because now you're getting your dividend income plus growth. But alternatively, perhaps the market suffers a big correction. Well, guess what? That could be great also. Why? Because now you're able to reinvest in more shares of stock at a lower price and watch your income increase faster as the market recovers. In other words, the beauty of having the right dividend-paying value strategy is that you could be happy when the market's going strong because you know you're getting a 4% plus dividend yield that's reliable and consistent and some gains. But you can also be happy when the market drops. Why? Because now you have the potential to increase your future income and your future growth through strategic reinvesting of those dividends that you don't need today. And like I said, that's why it's called a bird in the hand strategy. And it's what you get with investing for income. So Jeff, I'm just curious, when you're sitting with a client, what do you say to help that client determine their own risk tolerance level when it comes to stock market-based investing?
Well, Dave, obviously nobody wants to lose. However, if we go back to last March, if you were an investor and you had money exposed to equities at that time, think about how you felt. Were you able to withstand that volatility and say, look, we're going to get through this, these companies aren't going to fail, or were you too nervous? And that might make you feel if you were too nervous, it might make you feel like your risk tolerance is very low and you should have no exposure to the market. However, Dave, as you said, even when the market drops, that can be a good thing with the right strategy. Can you explain more about reinvesting in a down market and how that works?
Well, because if the market drops and you're reinvesting dividends, then essentially you're dollar cost averaging. Those dividends are going back in to buy a greater number of shares than they would have if the market is high. And therefore, it gets your average cost, your average purchase price down. But I want to switch gears for a second because some people today seem to be worried about the stock market because interest rates have gone up significantly. The 10-year government bond yield has pretty much doubled since the beginning of the year. What do you tell people who might be worried about the effects rising interest rates have on the stock market?
Well, Dave, that's a very serious concern because recently the market's been rattled by the rise of interest rates, but that rate's been going up organically. And that's a good thing for the market long term. It means earnings are going to go up. However, if rates go up and it's man-made, let's say, that is not good for the stock market at all, Dave.
And the bottom line is that dividend investing can work in any type of market. If the market's going up, hopefully the company's healthy, your dividends are going up, as we heard Steve Forbes say a minute ago, and the value of your stocks are going up. If the stocks go down, it works because at least your dividends are staying relatively sticky, at least hopefully so. And if you're reinvesting those dividends, now you're buying more shares in a down market. You're dollar cost averaging. So again, it's why I believe it makes sense in most different types of markets for someone who has the right risk tolerance level. Right now it's time to bring in a great personal friend of mine and Jeff's, Eddie Gabor, co-owner of Key Advisor Group in Delaware. Eddie's also the Amazon best-selling author of the book, The Common Sense Bull. Eddie, thanks so much for being here with us today on The Income Generation.
Thank you for having me.
So in your experience, do most people understand the concept of dividend-oriented value investing in the stock market, or not really?
Frankly, they really don't, and it comes to much surprise to me, even the more astute investors. I find myself many times really having to educate them quite a bit on the value that income does bring to their portfolio and their standard of living, because frankly, from my experience, they're always sold about how the next hot stock, the next Tesla, and the stock market to them is more about speculation and trying to get growth. And the dividends are overlooked, and it's a shame. But, we take a lot of pride in educating investors on that because we think it brings a tremendous amount of value to a diversified portfolio.
No, well stated, Eddie. On a different note, though, when we get through this coronavirus economy and we come to the end of it and things start to open up, how do you think that's going to officially change the markets and the economy, let's say, over the next 12 to 24 months?
Well, I think we're going to see polar opposites of what's going to happen here. We've told our clients we have two dynamics happening right now. We are going to see the largest acceleration of GDP growth on a year-over-year basis since post-World War II, as well as consumer spending. And that's probably the next 4 to 6 months. After that, our best guess right now, and we'll know when our data tells us so, that by fourth quarter, we will be de-risking because this is the mother of all bubbles. And I think that bubble is going to start to show signs of cracking, like the NASDAQ already has. And it'll start cracking in the fourth quarter. And then by sometime next year, we think we'll start to see certain sectors start to pop. And we don't want to be on that side of the trade.
So that was going to be my final question. I guess you just kind of answered it real quick. Opportunities as well as risks right now in the stock market. It sounds like short-term great opportunity, long-term risk. Am I hearing you right?
You're exactly right. This economy is going to get very overheated over the next few months, and then inflation is going to smack us in the head, and that's when those cracks are going to start to show.
Eddie, great words of wisdom. You always help our income generation every time you're on the show, and we thank you for that. Thanks so much for being with us today.
Thank you, Dave.
One thing that I like to say often about investing is that it's simple, but not easy. In other words, a lot of the concepts of investing, such as buy low and sell high, they sound simple in principle, but they're a lot harder to implement in practice. And as we've seen today, that's certainly true when it comes to investing for dividends in the stock market, despite this common misconception that it's an easier way to invest compared to investing for growth or momentum. But here's the fact. Any kind of stock market investing carries risk. And that's why the right risk tolerance is so incredibly important when it comes to this type of investing. With that said, as we've also seen today, if you do have that risk tolerance and you want to stay in the stock market game, a well-managed portfolio of higher dividend-paying, value-oriented stocks can be a sound part of your overall income-based strategy. And for many reasons, it can be a much better way to invest in the market within 10 years of retirement than the growth-based strategies that you might still be using. Thanks for joining me once again on The Income Generation. And a special thank you to Steve Forbes, Jeff Small, as well as all of our guests. We've had a great time here today. And don't forget to tune in next week. And remember, it's all about the income.